Hey folks, CB3 here with your monthly market update. We're going to look back to April and look ahead into May to see what's up ahead for the second quarter. April was one of the most volatile months on record. May is starting out a lot better, but the tariff situation is a great unknown. Stay with us. The monthly market update starts now. Before I begin the monthly update, I have a programming change that you need to be aware of. Our compliance department at CB3 Financial has decided that we need to separate our monthly performance from my general market commentary, and that's because we have many people listening to this that are not CB3 Financial clients. The SEC requires that we have a differentiation between our actual clients and what we talk about on those programs and our actual performance. So we're going to separate that. You're going to hear about an upcoming podcast, a private channel for all of you who are clients, and you'll have a much more detailed portfolio performance in that section, but you'll have a private login and it won't be for the general population. So April's roller coaster from panic to partial recovery, just crazy, extreme volatility, $6 trillion in value in the S&P 500 at one point in the month, S&P down 11% at its worst point in early April. The story didn't end there because the White House then decided to pause for 90 days all the tariffs that had been slapped on April 2nd. And that helped spark a dramatic rebound with the S&P staging a 7-day winning streak to close out the month, its longest in 21 years. But despite this, it still ended down for the month. The Dow was down for the month. The Nasdaq squeaked by with just a little bit of a gain. So what drove these swings? It's almost entirely tariffs and trade policy. Uncertainty over U.S. trade policy just caused chaos in the markets, especially as it relates to our trade policy with China, Mexico, and Canada. Weakening GDP, gross domestic product, also a slowing job market caused a downward revision to economic forecasts, fueling concerns about a potential recession. We'll get to the recession in just a few minutes. Inflation remains stubbornly strong with the Fed's target at 2%, but clearly the data is showing inflation at a higher number than that. The first cut is now expected in July, not June, so that deterring of the first cut also put some jitters in the market because traders want low interest rates. The bond market showed a little appetite for treasuries, but a worrying sign of $9 trillion in government debt that has to be refinanced took the buyers away from the market. So this is what happens when a government our size has so much debt that no one wants to buy the paper, or they're insisting on a higher interest rate. And of course, that affects the bond markets, which affects the stock markets. So I referenced earlier the talk about recession. The number one question I get from clients is, are we going into a recession? And if we are, what does that mean for my portfolio? First off, this market summary is not going to cover that in great detail because I'm going to do that this next Thursday night on my monthly CB3 live show. But what I can say is the probability of a U.S. recession beginning in the second quarter, that's the one in which we currently are, has increased, but a downturn is certainly not a certainty. And here's why: because GDP did print a negative 0.3% just a few days ago. However, and this is really important, you're not going to see this in the corporate media, that minus 0.3% includes people front-running inventories to get out of the way of the effects of the tariff. So they were draining their cash reserves to buy inventory at lower prices, which drove down GDP. Artificially so, in my opinion. If you take that component out of the data, we actually had a plus 1.9%, almost 2% positive GDP. So it is unquestionable that the tariffs are affecting not only market sentiment, but the actual data on gross domestic product. So what are the biggest recession risk factors? Tariffs and trade policy, I've already mentioned that. The 10% on almost all countries is definitely going to affect the sentiment for people to pull back on their spending and therefore risk a recession because we are a consumption-driven society. Number 2, corporate and public sector weakness, elevated corporate debt, rising public debt, and the termination of thousands of government employees who will no longer be spending at the same rate that they have been is a second factor. The third factor is the labor market is softening. Although the jobs data that was published today, Friday, May 2nd, was positive and somewhat shocked the market, it still means that the number of openings is declining, okay? And that is a concern. Low hiring, low firing, this kind of environment could lead to more layoffs. And finally, monetary policy. The Fed right now is not our friend. As you probably know, Donald Trump and Jay Powell are in almost constant bickering about whether rates should be lowered. Trump saying they should be, Powell saying we are an independent agency and we're not going to be told what to do. So this kind of acrimony between the Fed and the executive branch is not positive for the markets. As far as the experts, JP Morgan says the possibility of a recession this year is 60%. There are others that are saying 50%. I am in the 30 to 40% range, and I have to see what the GDP looks like when it's revised. We just got the original report a few days ago, but later this month, May, and then again in June, there'll be a first and second revision. Those could actually be revised up if somewhat of the data is extracted and they don't have the effect of the tariff hoarding of supplies, as I just described earlier, or if several trade deals are signed and the market has a strong recovery from that. Obviously, you can't go back and change the data, but it's the interpretation of the data that's really key at this time. So what's the short-term outlook? The risk of a recession is elevated, but many people see it as not excessively risky right now. So what's the conclusion? While a technical recession with 2 quarters of negative GDP is not confirmed, the risk of a downturn starting soon or in the second quarter has risen somewhat. Let's wait for Trump to get a trade deal from a major country like India, like Japan, like England, like Germany. And if that happens, I believe you'll see consumer sentiment turn around, and then it isolates China and forces them to come to the table with a less favorable deal. And that's really key. China is the ultimate destination here for these tariffs. And if all these other major economies settle a deal with the U.S. that's in our favor, and I believe that's the only kind that President Trump will sign, then the Chinese will come to Washington and realize if they don't get on the bandwagon, they're going to be left out in the cold with a much, much worse trade deal and with their factories hurting because they need American buyers. Looking ahead, May 2025, this month, trade talks will continue to remain at center stage without a doubt. Other key partnerships we're waiting to see signed: Mexico, Canada, Japan, the Eurozone, even Switzerland, which promised to build $50 billion worth of pharmaceutical manufacturing here in America. Roche Pharmaceuticals promised to do that. And the April jobs report obviously beating expectations, but there still is a concern about consumer confidence and therefore weak consumer spending. Federal Reserve policy, I mentioned earlier, Jay Powell needs to lead the market with some sort of confidence in his tone that there will be at least 2 cuts this year, July and September, if not more. So my final thoughts on this as we wrap up the April-May monthly market update. April reminded us just how quickly sentiment can shift to the downside and then to the upside. We had to make adjustments in all of our programs. It was one of my busiest months trading because I don't know if this is the beginning of a major downturn like 2008. At the time, I don't know it. Now, at this point, we are fully invested in our programs. As I said earlier, I have to separate what I'm doing in the actual performance of CG, GI, and DS. And if you are a client and you want to see that performance, contact us, CB3 at cb3.com, and we will give you access to the private client VIP portal so you can see performance. We're going to stay nimble. We know volatility is going to stay heightened. We got to keep our eye on the headlines and remember that in markets like this, risk management is the most important benefit we bring you, our investors and our listeners. If you're not a client of ours, that is just fine, but understand that risk management is always the most important objective at our firm. Thanks for listening. Stay with us. Do not miss Thursday night, May 8th, the next episode of CB3 Live, and we will see you next time on the CB3 Market Update channel.